Hello and welcome to our latest Insider interview. Today I am joined by Neil Hermon, who is the fund manager of the Henderson Smaller Companies Investment Trust. Neil, thanks for coming in today.
Thanks for having me, Carl.
In 2022, UK smaller companies have notably underperformed UK larger companies. What needs to happen for that to change in 2023?
Yeah, I think there's, if we go through here, there's kind of a number of reasons why markets have been so difficult in 22. I think there's a number of reasons. So starting off with, we've had the zero tolerance policy towards COVID in China, which has impacted economic growth there. We've had the war in Ukraine, clearly not helpful for the geopolitical situation and risk taking, but also led to a significant rise in raw material prices around kind of metals and oils and food, and clearly what big impact there's been around energy prices. As Putin has weaponized the gas that they've been importing to Europe. That's exacerbated the cost of living crisis for the UK consumer or the Western consumer. We're seeing rising prices of anything which energy related, but also things like food, etc. We've also had a very much a different policy from the central banks. At the end of 21, you had a pretty dovish perspective on terms of inflation, as transitory, low interest rates and quantitative easing. Throughout 22, as inflation has become, perception of it become more embedded, central banks have turned more hawkish. So we've seen a significant rise in interest rates throughout the course of this year as they try to essentially compress or depress the economy for demand destruction to affect the kind of economic growth. We've also seen within the market a trend away from growth towards value. The impact of long-term interest rates rising means that the future cash flows of companies gets depressed. Clearly, obviously, that impacts growth companies more. And then more recently, from a UK perspective, we've had some sort of political shenanigans which have clearly been somewhat traumatic over the last couple of months. So, lots of reasons why markets perform badly. Mid and small cap has underperformed large cap. They tend to be more sensitive to the economic slings and arrows, and therefore, in a market where the economy is in a more difficult place, small mid cap tends to underperform. Where you get that flight to liquidity and safety of large cap. Saying that, you talk about what was going to happen from here and what's going to be. I think there's some reasons to be positive about certainly our space of the market, mostly about the micro, the companies we invest in. So the operational performance of our companies remain very robust. Although things have become more difficult. Earnings growth has still been very robust, so the portfolio has grown its earnings by around 19% this year and forecast 10% next year. In some ways, we've already had that underperformance, so markets move ahead of the reality. Mid and small cap down 20% this year reflects what they think about the future. And so we've already had the underperformance already in place, and that provides some opportunity going forward. Valuations are very low, been significantly compressed throughout the course of this year. I think if you look at any strategy piece you can look at, the UK market is very, very cheap. And that's also the case with our own portfolio. Balance sheets, very good order, lowly levered. Over half our portfolio's got net cash. So there's no financial risk there. We're seeing director buying. We're seeing dividends go up. We're seeing buybacks. So, companies think their own stock is quite cheap. So there's a number of reasons why we're quite positive about the micro fundamentals of our portfolio. What are the catalysts for things to get better? Probably three things I'd pick out. An end to the zero tolerance policy towards COVID in China. Some signs maybe that's kind of at the edges getting a little easier. A regular resolution in Ukraine. Unfortunately, no sign of that coming anywhere soon, but clearly, obviously, that would certainly help in terms of inflation and the gas price. And most importantly, really, it's around the market perceiving a peak in interest rates and inflation. It's the uncertainty which causes a problem rather than the certainty. So the fact that throughout the course of 22, the news on both of things just got worse and worse and worse. And interesting enough, last week, when the US CPI numbers came out, and they were actually below expectations for the first time in about 8-9 months, the markets performed very well. So that's what we really need for a kind of better environment for 23.
You've just given some reasons for optimism and named some catalysts. But obviously, the big elephant in the room is that the UK looks like it's going to enter a recession. Have you prepared the portfolio for that scenario, and how will the portfolio cope with this challenging economic backdrop?
So we haven't really changed the portfolio. It's been we're a relatively low turnover portfolio anyway. We do believe investing for the longer term within the companies and finding quality businesses will deliver long-term returns. So turnover is low. Average holding period of stocks in our portfolio is around 5 years. And it's very difficult trying to avoid economic movements in the context of small cap. We don't have many defensive type sectors. We can't invest in tobacco or staples per se. So most of our stocks are reasonably economically sensitive. So we haven't changed our philosophy process. We haven't changed the sort of things we look at all. But we do have structural growth drivers in our portfolio. Being a growth kind of fund manager, we're overweight in areas like software and media and electronics, which are generally going to grow over the longer term. So, we are cognizant of the fact that the economy is going to be a more difficult place next year, but I think our companies are well placed to deal with that.
The portfolio has around 20% in consumer discretionary companies. Could you name a couple of examples of firms that you think will be able to weather the storm of a predicted decline in consumer spending during a recession?
Yeah, I think it's a fair point. I think exactly about 20% of the portfolio is in consumer discretionary. It's very hard not to have anything in small cap, given it's quite a high portion of the overall index. So some of the companies I think will do well, or will survive well, given a more difficult environment next year. So first example would be Hollywood Bowl. So leading provider of bowling alleys in the UK. It's kind of the name really. Why do we like it? Very good management team. Got a very strong balance sheet. Got net cash. It's quite a resilient part of the market. Low ticket item, affordable treat for the family. And they've got some good opportunity of growth in the context of their rolling out their Pot Stars concept, kind of crazy golf, and also they're expanding in Canada as well. So we think that's going to well placed to withstand. Second example would be Young's. So Young's is a pub chain, particularly focused around London, South East, South West. High quality estate, freehold estate, quasi family run, so very conservatively managed. Balance sheet in an incredibly good place. Lovely pubs, places you and I would love to go and have a pint or kind of somewhere to eat, and a sort of high socio-demographic customer, kind of AB 30 to 54. Lowly levered, going to have opportunity to buy some new pubs as they go through the course of years. Things become more difficult. Trading well below its own asset value. So I think again that will I think survive and succeed into the future. Third example, Team 17. It's a kind of developer of computer games. That's a growth area in the market. We've been invested since IPO. It's delivered consistently throughout that period of time through developing new games, not AAA, but more the kind of A and AA games. And they've had a good recent success with some new games in the last few months. Plus, also made some very good acquisitions of strategically important things like buying in their own IP. So again, I think good set well for 23. And just to throw one kind of maverick one in the equation, which wouldn't logically be a logical place to put your money in a kind of a consumer downturn, is DFS. DFS is a leading retailer of sofas in the UK. Now, you'd think clearly in the context of a difficult consumer environment, big ticket items like sofas wouldn't be on the priority of consumers, and it probably won't be. And that we acknowledge the fact it's going to be a much more difficult year next year. However, good management team, very strong balance sheet. And what's been proved in previous recessions is that DFS is a winner. They've taken market share in every previous recession as some of the weaker competition goes to the wall. So although we know the next 12 months for DFS is going to be tough, as we kind of come out of this, as inevitably we will do because markets, economies are cyclical, it'll have a higher market share and a higher ability to earn more money going forward. So very cheap valuation today, difficult for the next 12 months, but I think in the longer term is a winner.
The trust pays a dividend, and on that front, dividend growth has been consistent since 2003. Could you name a couple of examples of income-paying smaller companies that you own?
Yeah, so exactly you said, we've got a good long-term track record of dividend growth on the trust. It's 19 years unbroken. This next year would get us into the kind of the dividend hero status, and that's really a function of the fact we're investing in high-quality growth companies that we do like our companies to pay dividends. So we think it's a good discipline to have. So we like profitable, cash-oriented, dividend-paying companies. Over 80% of our portfolio pays a dividend. So we think it's an important characteristic, and the growth in dividends has been a function of the fact these companies are growing their earnings, therefore growing their dividends. So, a couple of examples of stocks that, are higher dividend payers would be OSB, the buy-to-let lender, and, Victrex, a specialty chemicals business.
You've spoken about 2022. It's been a difficult year to be a smaller company investor. Are you confident that over the long term, say on a 5 to 10 year view, that UK smaller companies will outperform UK larger companies?
Yes. I think, the context here is that, smaller companies are less liquid, more volatile than large companies, and tend to be more prone to the swings of economic cycles. So in a time when things become more difficult, there's a propensity to underperform. However, you take a very long-term perspective, so a kind of 65-year view, which is the LBS review of the small cap impact. Smaller companies have outperformed by an average of over 3% per year against large caps, and that basically equates to using compounding up an 8-fold return. So the long-term returns of small caps is incredibly strong and much better than large caps. I don't think the reasons for that are broken at all. So it's basically about the law of large and small numbers, growing from a kind of smaller base, more innovative industries, the ability for management team to have more of an impact, a source of new ideas and technology. All those remain valid. So we don't see any reason why small companies won't continue to deliver great long-term returns for investors. This year's been difficult, but actually that doesn't really damage the long-term ability for small companies to do that.
And finally, a question that we ask all fund managers that we interview: do you have skin in the game?
Very much so. So as part of the bonus structure at Janus Henderson, some of our bonuses deferred, and that deferral goes into essentially Henderson smaller companies. So I've got a significant amount of deferred from that perspective. I've also bought equity during my kind of tenure at Henderson smaller companies and never sold a share. So it's a pretty large part of my financial wealth. I think that's really important. I think it's important to have alignment, and that can essentially, if you can't back yourself, who can you back? So yeah, very much I am very much aligned with other shareholders.
Good to hear, and thanks for your time today, Neil.
Thank you.
That's all we have time for today. For the rest of our insider interviews, you can check out our YouTube channel, where you can like and subscribe. Hopefully, see you next time.